This is Jack and his cattle farm. He wants to expand production, but he doesn't have enough capital. So he divides ownership of the farm into 100 shares and plans to sell them at the marketplace. Before that, he has to apply to the market administrator and disclose financial and operational details about the farm. Once approved, other villagers can subscribe and become shareholders of the farm. As the farm grows, they can receive dividends based on their shares and share in the profits. And just like that, Jack's farm is officially listed. At this point, each share is priced at 10 gold coins. After the listing, for various reasons, some people want to buy while others want to sell. The price is determined collectively by all the villagers participating in the trades. They gather at the market and each quote the price they're willing to trade at. Buyers and sellers line up on opposite sides, sorted by their offered prices. For example, the highest bid is 10 gold coins, while the lowest asking price is 11. Since the prices don't match, no trade can happen. Without a trade, the price stays the same. But once someone is willing to pay 11, a trade is completed. At that moment, the transaction price becomes 11 gold coins. So when more people are willing to buy at higher prices, the price goes up. Conversely, if more people rush to sell, the price goes down. Given these rules, let's imagine a scenario. Someone buys shares normally, then controls multiple accounts. They rapidly trade with themselves on both sides, creating the illusion of active trading. Would this artificially push the price up? Then they sell at inflated prices to unsuspecting villagers and cash out. In theory, it is possible. But in reality, it is market manipulation, and it often harms ordinary investors. That is why markets have regulators monitoring unusual activity. Their goal is to maintain a fair trading environment. When trading stocks, every investor is essentially making predictions about the future. Everyone thinks and acts differently. Some rely on price trends, while others react to good or bad news. Others factor in macroeconomic policies. Some even base decisions on what they think others will do. And some simply follow the crowd out of fear of missing out. Every individual perception affects the stock price. Together, this creates a complex and unpredictable system. This is the PvP side of the stock market. A game between investors. At its core, it is about predicting the expectations of the majority. In the end, those who misjudge things often end up buying at the peak, while those who are most accurate, or just lucky, walk away with profits. These subjective expectations and emotions drive sharp short-term swings in supply and demand. In the short term, the market repeats this story every day. But what happens if we zoom out over a longer period? You might recognize this kind of chart. It represents the Shanghai Composite Index over the past 30 years. It looks highly volatile. Even over the past 20 years, volatility remains strong. But if you look at the net asset value of all listed companies, it tells a different story. It shows a steady upward trend. This shows that in the short term, prices are like a voting machine, driven by sentiment and capital flows. But in the long run, they act more like a weighing machine. Eventually, they reflect the true value of a business. Along the way, some companies fail, while strong ones keep growing. Short-term movements are unpredictable, but they often create opportunities. They give you chances to buy or sell great companies. If PvP represents short-term competition, then finding great companies and holding them is PvEE. This requires focusing on intrinsic value, understanding industry cycles and market structure, as well as the broader economy, and continuously improving your knowledge of business and economics. Public companies release financial reports every quarter. The most important are the balance sheet, income statement, and cash flow statement. You don't need to be an expert, just focus on key metrics and the valuation ratios derived from them. For example, the price-to-earnings P and price-to-book PP ratios. PE can be seen as the time it takes to recover your investment. PB reflects how much you're paying over net assets. There are also metrics like dividend yield and PEG. With these, you can make comparisons, like comparing with competitors or industry averages. Then factor in business models and growth potential. Another approach is to estimate future value. For example, the DCF model favored by Warren Buffett. It values a company by discounting its future cash flows. Think of it like buying a house to rent out. If returns are lower than bank interest, it is not worth it. Of course, that is a simplified example. In reality, it involves many assumptions. Valuations vary widely across industries. High-growth sectors usually have higher valuations. Mature industries grow steadily, but have lower valuations. If picking stocks feels too hard, you can invest in entire industries. First, identify the industry's life cycle stage. Is it emerging, growing, mature, or declining? This shapes your investment strategy. You should also look at valuation, market size, competition, and policy, and technological changes. There is also sector rotation. Trending sectors shift over time. Above all that is the macro level. Market movements are largely driven by money supply. More money pushes prices higher. Monetary and fiscal policies directly impact markets, such as interest rates, reserve ratios, and stimulus programs. All of these can have huge effects. There are also economic indicators, such as GDP and PPI. They help assess the economy and guide investment decisions. Millions of people participate in the stock market every day. Your counterparties might be individuals or large institutions, whether short-term or long-term. Research is crucial. Finally, as Benjamin Graham once said, investing isn't about beating others. It is about controlling yourself. It is as much about mindset as it is about knowledge. Know your strategy and stick to it. And leave more time for life. Because the goal of investing is a better life. That is all for today. If you found this helpful, please like and follow. See you in the next episode.